All right, let's talk about the single most quoted and honestly the most misunderstood metric in the entire world of finance, the price-to-earnings ratio, or PE. We're going to break this down because getting this one thing right, or getting it catastrophically wrong, can literally make or break your entire investment strategy.
Take a look at this number, negative 60%. This isn't just a number, it's a financial disaster story. Back in the year 2000, Cisco Systems was on top of the world, the undisputed king of the new internet economy. Everyone wanted in. But for the people who bought the stock at its peak, well, this is what happened to their money's buying power over the next 24 years. Even with the company growing and making more money, those investors are still deep, deep in the red.
And here's the absolutely wild part. At the time, when Cisco's PE ratio was a sky-high 200, you know what the experts were saying? This. They were calling it reasonably valued. The people paid to know better looked at one of the priciest stocks in history and basically shrugged and said, yeah, that seems about right. It's just mind-boggling.
So you have to ask, how does that even happen? How does something that's supposedly reasonable end up sparking a $5 trillion market collapse in the dot-com bust? The answer, it turns out, is that everyone was using the same tool, the PE ratio, but they were using it completely wrong. They were telling themselves a story, and the PE was just the justification.
And this is so important. The PE ratio itself, it isn't broken. It's actually a fantastic tool when you know how to use it. The problem is how we think about it. We've been taught to treat it like a simple number, when it's so much more than that. We need a complete mental reboot on what this thing actually is.
This right here is the perfect analogy for the big mistake. Most of us, we look at a PE ratio like it's a thermometer. A low number means cold or cheap. A high number means hot or expensive. Simple, right? But that's not what it is. A PE ratio is way more like a weather forecast. It's not just a single reading. It's a complex prediction packed with expectations about the future, about growth, about risk. It needs to be interpreted. So the question you should be asking isn't, is it cheap? The real question is, why is it cheap?
Okay, so if we're going to start interpreting that forecast correctly, we first need to know which version of the forecast we're even looking at. Because believe it or not, there's more than one kind of PE.
You've really got three main flavors. First is the trailing PE. This is the one you see most often. It's based on the last 12 months of a company's actual earnings. It's a hard fact, which is great, but it's also yesterday's news. Then you have the forward PE. This one's based on analysts' guesses for what earnings will be next year. It's forward-looking, which is what we want, but it's also just an estimate, and those can be wrong. And finally, there's the Shiller PE. This one takes an average of the last 10 years of earnings and adjusts for inflation to give you a big-picture, long-term view. Each one tells you a slightly different story.
All right, next up is probably the most common mistake of all. It's this idea that you can just compare the PE of any two companies. That's like comparing apples and, well, oranges.
Just look at this. The average tech company has a PE around 28, but a bank or an energy company, they're down around 10 or 12. This isn't because the market is broken. It actually makes perfect sense. A tech company can build a piece of software once and sell it 1 billion times with very little extra cost. That kind of growth potential deserves a higher price tag. A bank, on the other hand, is heavily regulated and can only grow as fast as the economy. An energy company, its profits are tied to the crazy ups and downs of oil prices. So comparing them is totally meaningless. So how do you solve that apples and oranges problem? Well, there's a fantastic little tool called the PEG ratio. It's kind of a secret weapon. What it does is it takes the PE ratio and puts it into context by dividing it by the company's expected growth rate. The famous investor Peter Lynch said a PEG of 1.0 is a pretty fair deal. So a company with a high PE of 30 might actually be a better buy if it's growing at 30% a year than a company with a cheaper PE of 15 that's only growing at 5%. See? It's all about what you're getting for that price.
Now, when you start to understand these kinds of nuances, you can finally learn to avoid the two biggest landmines in investing, the dreaded value trap and its evil twin, the growth trap.
The value trap is that stock that looks like an incredible bargain with a super low PE. But it's a trap because it's cheap for a very good reason. The business is falling apart. Think of General Electric during its tough years. The low PE wasn't a buy signal, it was a warning siren. The growth trap is the opposite. It's the super hype stock with a crazy high PE based on a story of world domination, a story that turns out to be pure fiction. Pets.com, anyone? That was all sizzle and no steak. Okay, so we've seen all the ways this can go wrong. Let's flip this around.
How do we start using the PE ratio like a real pro, to go from just guessing to actually navigating the market?
It comes down to this simple 3-step checklist. First, always check the context. What industry is this company in? And what's going on with interest rates? When rates are high, PE ratios in general should be lower. Step 2, you have to investigate the E, the earnings themselves. Are they legit? Is the company actually generating cold, hard cash? A quick look at their cash flow statement will tell you if the earnings are real or just accounting magic. And third, compare it to its own history. Is this PE ratio way higher or lower than it's been for the last 5 or 10 years? If it is, you need to find out why.
And that brings us to the most important takeaway of all. A PE ratio is not a fact. It's not a number sent down from the heavens. It is the market's collective opinion about a company's future. It's the story that everybody believes right now. Your job, as a smart investor, is to play detective, to kick the tires and ask, does this story actually make sense? So don't let the PE ratio be your final answer. Let it be your first question. Master that, and you'll be ahead of 90% of the market.